me ask you something. Have you ever wondered why two people can borrow the same amount of money, but one ends up paying back way more than the other? Or why the world suddenly feels expensive, not just because of inflation, but because loans, houses, cars, and even businesses start slowing down at the same time? It's not always because people became lazy. It's not always because the economy collapsed. Sometimes it's because one invisible dial got turned and it changed everything. That dial is called the interest rate. And today, I'm going to explain what interest rates really are in a way you'll never forget. With a story about a strange product, a product you've been using your whole life, even if you never realized it. Imagine there's a store in your city, but this store doesn't sell shoes. It doesn't sell food. It doesn't sell phones. It only sells one product: money. Yes, a money rental store. You walk in and you say, "Hi, I need $1,000. The cashier smiles and says, "Sure, you can rent $1,000 for 1 year." You pause. "Rent money?" "Yes," the cashier says. "Money is like a product here. You don't own it. You borrow it." Then the cashier points to a big sign behind him. Today's price of renting money, 10% per year. That means if you borrow $1,000, you must pay back. $1,000 plus 10% equals $1,100. That extra $100 is the cost of renting money. And that cost is called interest. And the price tag, the percentage, is the interest rate. Interest rate is basically the price of borrowing money, and also the reward for saving money, because the same system works both ways. Let's make it super simple. Interest rate is the cost of borrowing money, or interest rate is the reward for lending, saving money. If you borrow money from a bank, the bank charges you interest. If you save money in a bank, the bank pays you interest. So interest rates are like the temperature of the economy. When rates are high, borrowing feels hot and painful. When rates are low, borrowing feels easy and cool. But no matter what, interest rates affect almost everything. Home loans, mortgages, car loans, business loans, credit cards, savings accounts, investments, even the price of stocks and crypto. It's one small number that behaves like a master switch. Now you might ask, why would I pay interest at all? Because money today is more powerful than money tomorrow. If I give you $1,000 today, I lose the chance to use it, to invest, to buy something, to handle an emergency. So interest is like a thank you fee for someone letting you use money early. But interest also exists because of risk. Because what if you don't pay back? The lender needs protection. So the interest rate includes the time value of money, the risk of not getting paid back, the profit for the lender, the economic conditions. So you're not just borrowing money, you're borrowing time and paying a fee for it. Let me tell you a short story. Two friends, Alex and Ryan, both want to buy the same car. Same model, same price, same dealership. The car costs $20,000. Alex buys the car when interest rates are low. Let's say the interest rate is 3%. Alex borrows $20,000 and pays a small amount of extra money. The monthly payment feels light. He still has money to live life. Ryan buys the car when interest rates are high. Now, let's say the interest rate becomes 12%. Ryan borrows the same $20,000, but now the payment becomes heavy. Suddenly, the car feels like a trap. And here's the painful truth. Ryan didn't choose a more expensive car. He just borrowed money at a worse price. So, in real life, sometimes people are not struggling because they are bad with money. They are struggling because the price of money went up. Here comes the bigger question. Who decides these rates? In most countries, the base level is influenced by the central bank. They adjust interest rates to control the economy. And most of the time, they do it for one main reason: to control inflation. Because when interest rates go up, borrowing becomes expensive, so people spend less, businesses expand less, demand slows down, and prices stop rising too fast. It's like this. If the economy is a wild horse, inflation is when the horse is running out of control. Interest rates are the reins. When the central bank pulls harder, the horse slows down. But if they pull too hard, the horse can stop completely, and that can cause a recession. So interest rates are powerful, but dangerous. It's like medicine. Too little doesn't work. Too much can hurt. Now let's connect it to everyday life. When interest rates increase, credit card debt becomes heavier, because credit cards often have high interest already. So if you carry debt month to month, it grows like a snowball. Home ownership becomes harder because mortgage payments become higher, meaning the same house becomes less affordable. So people stop buying, and the housing market can slow down. Businesses slow down because business loans become expensive. So businesses delay, expansion, hiring slows, salaries stagnate. Even if you never took a loan, you still feel the effects. Because interest rates influence the entire system. It's like the ocean. You might not be swimming, but if the tide changes, everything moves. So let's lock this idea into your mind. Interest rates are the price of money. When the price of money goes up, everything that depends on borrowed money becomes heavier. Cars, homes, businesses, dreams. And when the price of money goes down, borrowing becomes easier and the world starts moving again. So if you ever feel like life became expensive overnight and everyone suddenly started struggling, remember, sometimes it's not because money disappeared, but because money became more expensive to use. Interest rates aren't just a finance term. They are a silent force that decides how easy your life feels and how expensive your future becomes. Finally, this channel exists for those who are ready to rise. If that's you, like the video, subscribe, and let this be your daily reminder.